The IRS just announced changes for the 2025 tax brackets, but there are also benefits that are going to be expiring at the end of next year. So it's a good idea to start thinking about these things now as we're moving into the next year. So I'll move through these things pretty quickly and then give an opinion on whether it's good or bad. And if I haven't met you yet, I'm Dave Zoller, and this channel is mainly for pre-retirees and then also people who are already retired, because we've been helping people at Streamline Financial for the last decade and a half retire comfortably. And we're sharing the things that they're doing with you so that hopefully we can make your retirement even better. Now let's get into it. So first, the IRS has the updated inflation adjusted tax brackets for 2025. And the more the tax brackets increase, the better for us taxpayers. That's the summary, right? Because that means that more of our income is going to be taxed at a lower rate. And I'll show you an example. But this year, it actually looks like we're going to be seeing the lowest or one of the smallest increases in the past several years. And the reason why? Well, they say that because inflation is cooling, or they say that inflation is cooling, then also these inflation adjustments cool as well. So we can see here as the first example for single filers, we can see that from 2024 to what's going to be 2025, the increase is only about 2.8%. And I'll show you the chart for married filing joint next. But just as a reminder, if your taxable income is $11,926 here, that doesn't mean that all $11,926 is going to be taxed at the 12% rate, right? This first $11,925 is taxed at the 10, and then that additional dollar, anything above, is taxed at the 12%. And so it continues, right? Anything in this range is taxed at 12%. A lot of people think, the reason why I'm saying this is a lot of people think that, oh, taxable income is $120,000, and that means I'm paying 24% actual tax rate here. That's not true. We know we're in a marginal tax rate. So you could pause this here if you're single and you want to look at these a little bit more, but I'm going to move on to married filing joint tax brackets so we can see the change from 2024 to what's going to be 2025. So again, it's small change for increasing tax brackets here from year to year. But now let's move on to other changes that are happening. So tax deductions for 2025. Standard deduction is going to be going up. It was $29,200 last year. Now it's going to be $30,000 in the following year. That's for couples married filing jointly. And then for single, it's also going up by about $400. And then for head of household, it's going up by this amount here. And the next thing that's changing is related to the annual gift tax exemption. So we've got a client who actually, they want to leave their inheritance to their kids, but they'd rather do it while they are living versus when they're dead, because they actually want to see the joy and the things that they can provide for their family and for their grandkids too while they're here, because that's just so much more fun to actually see it. So this next one impacts them a little bit because they're doing the annual exclusion for gifts here. So it's increasing by $1,000, and they are married. And what they can do is if they've got let's pretend they have one daughter who's married to her husband. Spouse number one can give 19 and 19 to the family, and spouse number two can give another 19 and another 19, all in 1 year. And the main thing this is talking about is not having to file a gift tax return. That's the main thing. If you start to give a lot more than some of these numbers are big numbers, then you got to report it and tell the government about it. But this is, again, talk to your CPA and accountant if you're doing this, but gift tax exemption is going up. Now, how about retirement account contributions? Well, they haven't even updated that yet, so we don't know what the changes are. But how about Social Security? I don't know if I've got I don't have anything for that, but for Social Security, the increase for COLA, cost of living adjustment, is going to be 2.5%. This actually came out a few weeks ago, maybe a few months ago. But now let's get into the tax provisions that are scheduled to expire in about 13 months or so. And also, what is that going to mean for you? So there's a big one for business owners here too that I'll mention at the end. And then also, if you're still with me and you like this type of video, the update type videos, click the like button so that I know, and then I could do more of these types of things for you. So for the last 7 years, we've been operating under the Tax Cuts and Jobs Act, the TCJA, those provisions. But those are going to expire at the end of 2025. At least that's what they're scheduled to do. And if they do, what does that mean? So number one is most likely tax rates are going up, which is obviously not preferred. And then the other thing is standard deduction is going to be smaller, which means that we can deduct less off our income each year if we're doing the standard deduction. Now, one positive thing is that the personal exemptions are coming back. So I would say that that is a positive. You know, what am I doing with the arrows here? I'll color code it. This is bad because it's going up. This is bad because the standard deduction is going down. And then this one is actually good because they are returning. And the personal exemption, that's just the set amount you can subtract from your income for each person in your household. Next one, child tax credit is scheduled to go down, which if you've got kids, then that's a negative. And then the next one is actually a positive. SALT is currently capped at $10,000 a year on your itemized, if you're itemizing on your taxes. And what's going to happen is then if the sunset happens, then it's going to be uncapped. So if you're living in a high tax state, high real estate tax or state taxes, this may be beneficial to you where you can add that to itemized deductions sheet each year, where right now it's capped at 10K. So that's a potential benefit. And then the next one is estate. And we actually got one more after this, which is the business one, which I'll mention next. But for estate tax, this one I'd say is a negative because currently there's an amount of about, I'm rounding up here, 13 million. This is for high net worth people, if single, and then about 26. It's a little bit under 26. Anything above that, subject to estate taxes, these are going to be decreasing. An estimate, you know, I'd have to look at the exact number, but it could be 5 to 6 or, you know, around 12 million for couples here. So that would be a negative for people with those sorts of assets. And then for business owners, last one, number 7, I'd say that's a negative. What's happening here is bonus depreciation is set to completely expire. So this makes it less attractive for business owners to invest in new equipment or things like that, where a lot of times they could depreciate more of it in 1 year and get the deduction, whereas bonus depreciation is scheduled to expire. But it's always good to remember things can change here. So don't make any big decisions based on this and what the predictions are or what's scheduled to happen, but do stay up to date as we move into 2025. You know, it could be a big planning year for many people, especially if you're getting close to retirement. And if you want more retirement planning strategy videos, check out these videos here on some tax strategy and then also some investment strategy and how to live and make retirement your best years yet. I'll see you in the next video. If this was helpful, please give it a like, and then I'll see you there. Take care.